Well, welcome everyone to today's webinar. We have a great topic aligned for you, and we're going to go ahead and get going on this. We have a great guest with us. Tony is not a stranger for Sense Financial. He joined us in the past and joining us again to educate you guys on how you can keep more of your money and pay less in taxes. And the topic is real estate tax strategies, keep more and pay less. So we're going to go ahead and kick this off. Just a quick slide to introduce myself. My name is Dimitri. I'm the founder and president of Sense Financial. We are a boutique financial firm, and we specialize in creating self-directed retirement accounts with checkbook control for our clients. We've been serving our clients since 2010. Our clients love us because of our approach to service. We are not focused on acquiring new clients as much as we are focused on retaining existing clients. We have hundreds of 5-star reviews on Google, Better Business Bureau, Yelp, LinkedIn, and Bigger Pockets. And we assisted over 4,000 clients jailbreak their retirement accounts. Alrighty, just a quick slide on the benefits of the self-directed IRA and solo 401k. The main reason people come to us because with self-directed IRA and self-directed solo 401k, you have the ability to invest in alternative assets. That means that you can achieve true diversification, which you are unable to achieve with conventional retirement accounts. The returns in this investing in these accounts are deferred from taxes, and it can be tax-free when you use a Roth account. You can also leverage your funds with non-recourse loans. We empower our clients with checkbook control over their IRA and 401k. And if you use a solo 401k, it's also a great tax shelter because you can potentially contribute over $70,000 as a single individual, or if you join with your spouse as a partner in the business, then you can potentially double that. So this is a great tax shelter. You can do a lot of things, virtually unlimited investment options, but IRS puts a stop sign when it comes to a couple things. So there's a lot of options that you can invest in, but you cannot invest in collectibles and life insurance, and you cannot invest in any transactions that involve disqualified person. And disqualified person is immediate family members. Unlimited investment options means you can buy real estate. You can actually own a rental property inside of your retirement account. I've done it myself. Many of our clients done it. You can also invest in commercial real estate as a limited partner in a syndication, perhaps. If there is someone that offering commercial investment properties, you can actually come in with a smaller amount and you can own a piece of that using your retirement funds. You can invest in trust deeds, tax liens. You can invest in precious metals, cryptocurrency. You can be the bank and you can provide financing to other investors as a private lender. So true diversification is what the self-directed retirement accounts are all about. Ecclesiastes 11:2 says, divide your portion to 7 or even to 8, for you do not know what misfortune may occur on earth. There's a lot of wisdom in that. If you put all of your eggs in one basket and that basket fails, then all of your investments are potentially at risk. But when you invest in various asset classes and you understand those, and you don't have to go across hundreds of different platforms, but just a few to provide you a peace of mind and diversification. That will be a wise move for you to do. Next, we're going to go ahead and bring Tony And Tony is also a real estate investor and a tax professional. Tony, he personally manages clients with over $500 million in real estate holdings. He had spoken for hundreds of trade organizations throughout state of California, and he holds a license of enrolled agent tax practitioner with the IRS, and he can advise, represent, and prepare tax returns for individuals, partnerships, corporations, and any other entity tax reporting requirements. Tony is a true professional, and he knows what he's talking about. He's been helping me personally for over a decade. And aside from his full-time position at Robert Hall & Associates, Tony is an active real estate agent and enjoys short-term and long-term trading. So with over a decade and a half of experience, Tony, along with his team at Robert Hall & Associates, actively look for newest and the most up-to-date strategies to implement on his clients' tax filings. They all operate with the same goal in mind, to help taxpayers keep more of their wealth and not overspend with the federal and state revenue agencies. Tony, again, welcome, and go ahead and take this over.
Great. Thank you, Dimitri. Always a pleasure to share the digital podium with you and like-minded individuals. I just want to be very clear. I'm not a real estate agent, real estate investor. So I just want to make sure everybody knows that my main hat is the tax advisor. But I do enjoy investing in real estate. I've been investing in rental. I come from a rental property investment family. My father and my mother have both been real estate investors for a very long time. And as soon as I was able to save up enough pennies to buy my own properties, along with my brother as my partner, we started investing back in 2007, 2008 was probably our first year purchase. But when I started working in the tax world, I realized very quickly after seeing what my clients were able to utilize their real estate tax shelters as with their tax filings and how much money it saved them, how much wealth that they were able to grow in equity in the long term and cash flow. I realized very quickly that if I didn't learn this part of the tax code like the back of my hand, not only would it not help me in my own personal world, but I wouldn't be able to assist and help my clients moving forward with their investments. So once again, thank you so much to Dimitri, Sense Financial, for having me back. Welcome everybody. Today's topic, real estate tax strategies. Obviously, the goal is always to keep more and pay less. I'd say probably the third day of working for Bob Hall, he had told me something that still rings in the back of my memory today. It's not about how much you make. It's not about how much you spend. It's about how much you get to keep. And through proper tax planning and strategizing, and most importantly, implementing those strategies and those plans that we put together, you can effectively pay your obligation in tax and not a penny more than that obligated amount, and in turn helping you retain wealth. So a little bit about me. I know Dimitri had mentioned, my clientele roster ranges roughly in the $500 million in managed real estate and other business dealing range, and I am a keynote speaker as well as a tax professional. So I speak at over 140 plus events on an annual basis. I am going on 2 decades of service with Robert Hall & Associates, so I've had the unique pleasure, I'd say, of working through recessions, pandemics, presidential changes, tax code changes. I'd say that probably over the last 20 years, it's given me what I feel like to be 50 plus years of experience. And this year is very unique in itself. This is the first time in my 20-year career that I've been this far into the new year without tax code guidance. And I know that it doesn't settle well in the taxpayer's stomach. It definitely doesn't settle well in my stomach. My gut has been turning, trying to figure out, how do we approach planning when we hop on the phone with our clients during tax season? Then April 15th passed. We had the wildfire, so a lot of our clients went on extension through October 15th. So now we're sitting, June 5th today, and we still don't have a final tax bill. We have some idea of what may change, what might be brought back, what might go away, what credits are going to be available, but these are grand assumptions on our end, grand assumptions on everyone's end, and anything that you're hearing about on the news stations or on TikTok or Instagram, wherever you're getting your information from, just understand that nothing has been finalized. Nothing has been stamped or signed by the President of the United States yet, so everything is still very much up in the air. I'm hoping, and crossing my fingers, knocking on wood, whatever I can do to push forward and hopefully have a tax bill, hopefully in the next week to 2 weeks. I think that's wishful thinking, but we'll talk a little bit about what potential changes I think will come about. But obviously, Dimitri, once we have a new tax bill signed and in place, we'll probably have to hop back on the webinar platform and give the most up-to-date information. By no means am I a one-man operation. I work for a 54-year-old accounting firm based in Glendale, California. We service 38 or 39 states consistently. We have had clients in all 50 states before. So if you have investments outside of California, we can assist with filings in those states as well. But here's a lovely picture of our 54, 55 employee staff here. I work alongside a wonderful senior consulting staff. There probably isn't a tax scenario that we haven't seen or dealt with or advised on. So don't think that any particular situation that you're in is too complicated for us, or in fact, don't think that any questions that you have are dumb questions. I have to always remind people that the only question that is dumb is the question that goes unasked, right? Because if you don't ask it, you're going to go to the wrong platforms online, probably get conflicting information. And as fine-tuned as ChatGPT is these days, and I would love to assume that ChatGPT would be a good resource for information, which it is for the most part, but when it comes to tax bill, tax code, tax implementation, tax strategy, you still need a licensed tax advisor to review that information and just make sure it applies to you specifically. I think that probably in the next 5 to 10 years, maybe even sooner than that, ChatGPT will be a good resource for education and information. But I do believe that you will always need a licensed, educated tax advisor to review that information before moving forward with making any significant financial decisions on that end. We've been around since 1971. We service, I think this number is a little out of date. Last time I checked, we're a little bit over 11,000, closer to 12,000 tax returns that we file. Obviously, we need that kind of manpower here at Robert Hall & Associates, 54, 55 employees, to service that many files. But like I mentioned earlier, there probably isn't a tax scenario that we haven't seen or advised on. We've got great reviews online. Check us out online, roberthalltaxes.com. We're kind of a one-stop shop for all of your financial needs. Obviously, our main service is tax preparation services, but we do also offer incorporating services, audit representation, bookkeeping services, payroll, you name it, we've got it. And then obviously we have a wonderful list of vendors, or an extensive list, I'd say, of wonderful vendors that we refer to, including Sense Financial and Dimitri and his team. I've known Dimitri for a very long time, and I can tell you right now that our two industries, they go hand in hand. It's that kismet relationship, because when it comes time for funding a retirement plan, we need options. I know that some people like to play around with their stock investments like myself. I love short-term and long-term trading. I watch the market on a daily basis. First thing I do at 5:30 a.m. in the morning when I wake up, I roll over, I pick up my cell phone and I check the market, see how things are, reposition my investments. But that's really on the actual brokerage side. With my retirement side, I like to self-direct things like a lot of my clients do. And a lot of people don't realize that they have options in retirement. And I'm not talking about options as far as, where to save money and whatnot, but options as far as retirement portfolio and investment shelters are concerned. And it's amazing to me that self-directed investing and solo 401k investing has been around for 40, 50 years. And there are still people out there that think that they need to only have, or their only option is a traditional brokerage account within a 401k and an IRA, and that's just not the case. So absolutely utilize our services for our free consultations. We offer 30 minutes in person or over the phone. Once we dial in a really great strategy for you, we connect with our associates and our vendors like Dimitri and Sense Financial to make sure that we have you structured and set up correctly prior to year end. We're only halfway through 2025, so we've got plenty of time this year to plan ahead. However, we are kind of stuck between a rock and a hard place because we know what 2024's tax bill looked like. We just don't know what 2025's tax code is going to look like just yet. Before I hop into what some of those changes may be for 2025, I do have to mention I am not an attorney. Even though I might seem to step out of my lane of expertise from time to time, all of the information that you're going to hear from me today is solely from a tax advice perspective or direction. I am not trying to give anybody legal advice. So if you do take something that I say today as far as legal advice, please just double check with your legal advisors to make sure that it's buttoned up, because they are the professionals in their world, just like attorneys always refer their clients to us on the tax side for tax advice, because they don't want to overstep their lane of expertise as well. So some of the major changes on the horizon for 2025, at least what I think will stick once the bill is signed, it's passed the House. It might actually get kicked back to the House after the Senate reviews, and then the Senate's going to sign off on a lot of things, and then Trump obviously has to sign the final tax bill and the spending bill. But some of the major changes I'm looking forward to hearing more about is the deduction of interest paid on auto loans, which I believe back in the 80s there was a deduction for auto loan interest. Trump is trying to bring back that benefit. However, the stipulation here to take this write-off is that the vehicle that you're writing off the interest on has to be manufactured and made here in the U.S. I think a lot of those foreign automotive companies will get around this restriction by building 95% or 98% of the vehicle elsewhere in the world, shipping the final product here to U.S. soil, and then maybe installing the GPS software here on U.S. soil. And that way we can stamp that final destination or final location of manufacturing as U.S. soil, which might help us get around some of these limitations. We're waiting to hear more detail on that. Increase of the child tax credit to $2,500 through 2028. Right now, the child tax credit is set at $2,000. I'm really disappointed that the child tax credit is not greater than $2,500. During the pandemic, it actually jumped to, I think, $3,600 per child at one point. And I do think that based on inflation and cost of living, cost of feeding kids these days, especially if you want to feed them healthy foods, and with the tariffs and the cost of everything going up, I really feel like the child tax credit should be more around $3,500, but we're waiting to hear on the final verbiage on that end as well. The higher standard deduction, it always continues to increase with inflation. So I'm surprised that this was a highlight of what potentially is changing in the tax bill, because the standard deduction always changes. It always increases year over year. So we're waiting to hear what the actual final standard deduction rate is is going to be through 2028. The reason why Californians and New Yorkers aren't really very excited about this change is because follow my train of thought for a second. If I have mortgage interest and I have property taxes and charitable deductions as Schedule A write-offs, right? And let's call that number $40,000 between mortgage interest, property taxes, charity. That means that I am well above my standard deduction. If I'm married filing joint, current standard deduction is around 30 grand. And if my mortgage and my property taxes and charity is 40 grand, then obviously I'm going to take the itemized deductions and not the standard deduction. Well, let's say the government bumps that standard deduction to 40 grand. Well, how much of my mortgage interest and my property taxes and my charity is actually a write-off at that point? Well, nothing, because it's equal to the standard deduction. So I'm paying all of this money to U.S. Bank or Bank of America in interest. I'm paying all of this money to the local ordinances for property taxes and sales tax and use tax in the state of California for state income tax, right? So my SALT limitation at the moment, which we're going to talk about next, is capped at $10,000. All of a sudden, when you add up all of these things, if it's equal to the standard deduction, technically you're not taking any of your home or your charitable deductions as write-offs, because the standard deduction is equal to your itemized write-offs. So I'm not really too excited about the standard deduction. It really doesn't give anybody the drive or the need to own a home. We all know why we buy real estate, right? We all know that the long-term equity, the cash flow benefit is there, but the general public looks at real estate as a tax shelter. And all of a sudden, if my standard deduction is so high to where if I go out and I buy a home for 400 grand and I'm looking at it as more of a tax shelter, not a wealth building tool, and my itemized deductions aren't greater than 40 grand, I might think to myself, once again, the general public across the 50 states might think, well, why would I buy that piece of real estate if it's not going to save me any tax, right? So there's got to be a lot more education involved in teaching people the true reason and the benefit and the reward in buying real estate investment property. So that's what we're fighting the good fight on our end. The one thing that I'm very, very excited to hear more about is the increase to the SALT limitation, which right now currently is capped at $10,000. That means that whatever you pay in property taxes on your primary residence, whatever you pay in property taxes on a second personal residence, not a rental property, but a second personal residence that you use personally, mountain house, a beach house, whatever it is. If you've made great enough financial decisions to own 2 homes personally, the state and local tax cap is still at $10,000. There is a chance that the federal government under this new bill will bump that $10,000 cap to $40,000. And then it'll start to phase out or shrink once individuals make over 500 grand. Now, we don't know if it's going to be 500 grand for a married couple and 250 for a single individual, or 500 grand for a single individual and $1 million for married filing joint, or if it's just going to be straight up 500 grand for everybody, whether you're married, head of household, or single. These are all the intricate details of the new tax bill that we just don't have yet. And this is incredibly concerning to me as of June 5th today, being this far into the new year without advice for my clients. And as you can imagine, there are millions of accountants across the globe that are stuck in the same position as we are, where we would like to think we know what's going to happen for 2025, but we just don't know. So as soon as we have that final bill, we'll have a better idea of how to pivot and start strategizing for the 2025 tax year. Let's talk about some of the most common deductions for real estate professionals and investors. I mean, these are deductions not only that I've kind of data pulled off of my clientele list, but also deductions that I take on my own Schedule E's, on my own Schedule A, so on and so forth. And not only the rental property specific expenses like mortgage and property tax insurance, but some of the other deductions that we tend to overlook when we go to file our returns and have these very unique tax forms that we file with our 1040 return or an LLC return, so on and so forth. Number one, I mean, probably one of the most powerful deductions for real estate professionals and investors is marketing and advertising costs. When you have a vacancy and you need to fill that vacancy and start kicking in more cash flow, or during that vacancy you've decided to put a lot of improvements into the property, and now you need to take better pictures of the property in 4K or 8K, and now you're increasing rents because of all of those renovations that you've done, you will have marketing and advertising costs. I mean, this is a very general category. It could include a lot of things for you as a real estate professional or investor. Have this conversation with your tax advisor as to how you can maximize this position on your Schedule E, your Schedule C, your LLCs, your S Corps, your C Corps, because this deduction in particular is a dollar for dollar offset to federal and state income. So it helps you reduce dollar for dollar your federal and state income on Form Schedule E, Schedule C, LLC, 1065s, 1120Ss, so on and so forth. So make sure that you're maximizing these dollar for dollar write-offs to help further reduce taxable income. It's no surprise that coming out of the pandemic that most people had to work from home for a certain period of time. I'm now back in my office, but for 2 years I worked from home during the pandemic, because the LA Health Inspector's Office came to our location here in Glendale and said, hey, listen, you guys see 120 people every single day during tax season, Monday through Saturday. We can't have that during the pandemic. We can't have a super spreader office location in Glendale. It was a silly time in my career because I didn't know if we were going to make it through it. Staff was moving out of California because they needed different lifestyle benefit. It was just a weird time in everybody's lives. Nonetheless, we were forced to work from home. We were forced to upgrade our digital software and security and equipment and our desks, our chairs, our filing cabinets. I mean, I wasn't just able to pick up my desk in my office and move it home. So I had to upgrade all of this stuff at home so I could pick up right where I left off as soon as we were forced to move to remote work. These are incredible deductions for a number of reasons. Number one, professional supplies and equipment has one of the lowest audit risks. I mean, how many people do you know who can do what they do day in and day out professionally without a laptop, without a cell phone, without a desk, without a chair, without a filing cabinet? I mean, these are some of the most common write-offs for business owners and investors. So one, it has a very low risk for audit. Number two, it is in most cases a dollar for dollar offset to federal and state income. However, if it is a large piece of equipment that has a 7-year lifespan, it may be dollar for dollar deductible on the federal side, and there may be some limits on the state side. This is where Nevada and Texas and Florida really win from a tax code perspective because they have no state income tax, and all they really need is the dollar for dollar benefit on the federal side. Part of this bonus depreciation change that Trump might be bringing back is the benefit of 100% bonus depreciation, which will bring back that massive windfall write-off for large pieces of equipment, even vehicle purchases, which we'll talk about next. But make sure that you're maximizing these deductions: new cell phones, new computers, new printers, new fax machines, new Wi-Fi routers, any sort of equipment or office furnishings. Make sure that you're maximizing those deductions dollar for dollar on your Schedule C, Schedule E, or entity returns. So bonus depreciation, like I had just mentioned, has set to phase out under the Inflation Reduction Act, but the Trump administration is seriously considering, and I believe there's a 99% possibility that this is going to be solidified in this new bill, bringing back the 100% bonus depreciation benefit. Now, this not only affects the real estate industry, but it also impacts the automotive world, the automotive industries, where bonus depreciation impacts cost segregation elections on real estate investments, which once again we'll talk about in a couple slides here. But this particular slide, we're going to talk about how to utilize bonus depreciation for vehicle purchases. Now, I'm not telling everybody to leave their houses today and to go buy new vehicles specifically for tax write-offs, right? These are depreciating assets, so it's really only the benefit for individuals who need to update their vehicles. I have a lot of clients who contact me throughout the year saying, hey, listen, I've got this 2013 vehicle. The engine has had a lot of work done to it. I just don't know how long I'm going to have this vehicle for. Is there a specific way that I need to acquire this new vehicle? Is it better to lease versus purchase? Number one. Number two, should I lease it under my business name or purchase it under my business name? Do I need to buy it outright to get the tax benefit, or can I finance the vehicle and borrow from a bank? Well, these are all great questions, and I don't have a lot of time today to dive into the intricate details and breakdown of all of those scenarios, but just understand that if you are looking to purchase a vehicle, there is absolutely a right and a wrong way to title, insure, and pay for that vehicle. In order to solidify the bonus depreciation benefit on your tax return, you need to have this conversation with your tax advisor first, just to make sure that you understand how to title the vehicle, how to insure the vehicle, and whether or not that's going to increase your premiums by purchasing it under a business name versus financing or purchasing it under your personal name. The do's and don'ts, essentially. If you're not looking to buy or lease a new vehicle, because leasing is great as well, but leasing is just renting somebody else's asset, and it is a dollar for dollar write-off, but still, you have to lease it under the name of a business. You have to pay for it under the name of a business. You have to insure it under the name of the business in order to get 100% of the lease payments as a deduction. If you do all of this personally, you're going to have to split the deduction between personal use and business use. So once again, as you can see, it kind of opens up a lot of conversations here, and I just don't have time to sit and map out all of those scenarios today with you. But that's why we offer free consultations. So if this particular slide, lights up flips on a switch and lights a light bulb of a question for you, sign up for one of our free consultations. We could dial this in for you. If you're not looking to buy or lease a new vehicle, then mileage is probably the deduction that you're going to lean on. But we do need to look at what your actual auto costs were versus mileage to see which one is going to save you more. So we're talking about new tires or oil changes, engine overhauls. I mean, if you add up all of those actual auto costs and that is greater than the mileage deduction that you're allowed, we might take the actual auto costs over the mileage write-off. So either way, we need to have this conversation with our clients to make sure that we're best positioning them with the largest write-offs, is what I'm saying. Number 4, legal and professional fees. A lot of people back in 2018 thought that their tax preparation fees were no longer a write-off. And for the most part, for some taxpayers, that was true. If you are a full W-2 employee, meaning that you don't own rental properties, you don't have self-employed businesses, and you have tax preparation fees or attorney fees, and you're trying to write those off against your W-2 employed income as an employee, that form on the federal return no longer exists. So technically, your tax preparation fees, if you are W-2'd, no longer a federal write-off. However, the state of California never conformed to this part of the IRS code. So California still allows it as a write-off. And so a lot of times clients will come in and they'll say, well, Tony, I didn't add up all of these expenses because I figured it wasn't a write-off anymore. And I say, well, it might not be a federal write-off, but it is still a great state write-off. So I have to send them back to, the drafting board and have them add up all of those expenses. Then we add it on for the state benefit. But if you are a rental property investor or if you are a self-employed individual, there is still very much an itemized deduction for legal and professional fees. So bring everything. The reason why I'm bringing this up is bring all of your expenses to the table when you meet with your tax advisor and let us determine what is deductible and what's not. Because sometimes we can take advantage of an expense, even though it might not be 100% right deductible. We can take a portion of it, which portions of deductions add up to be larger tax shelters, right? So we want all of the information from you, not just what you think is a potential tax deduction. Keep that in mind. Last but not least, number 5, bonus depreciation cost seg for rental property. So like I mentioned, bonus depreciation applies to the vehicles and the purchasing of vehicles, whether you buy it outright or finance it, it all applies to that automotive deduction. But for real estate investors, bonus depreciation really makes the most sense for rental property owners. So the number 5 deduction for real estate investors is going to be the election for accelerated bonus depreciation. This was just a hot topic over the last decade, I'd say, especially and specifically in the years when 100% bonus depreciation was available. For those of you who don't understand how bonus depreciation works, I'm going to break it down into a much easier way. I wouldn't say easy. It's easy for me to break it down, but hopefully this brings some clarity to how bonus depreciation works and the power behind making unique elections to accelerate bonus depreciation. So here is an organic, like real life example for you. Back in 2022, taxpayer A came to me as a W-2 wage earner for LADWP. He owns a 3-property portfolio. He's a single individual, and that W-2 that he's got from LADWP is $120,832, and then his cash flow through his 3-property portfolio is sitting at about $33,000. Taxpayer A comes in as a new client and says, hey, listen, I see what I made in 2021. I see what my cash flow is. I've already put all my money that I want to into my properties. I really don't want to renovate kitchens. I'm looking at nice cash flow, but taxpayer A's goal is to retire in the next 3 to 5 years, right? So by 2026, 2027, he wants to leave LADWP, reinvest all of his retirement and any monies that he has saved up into more real estate investments, and literally live off cash flow, the dream of any real estate investor. And so he says to me, Tony, well, is there any way that I could further reduce this 33 grand cash flow? Because I don't want to pay $4,000 to the IRS, and I don't want to pay $4,200 to the state of California, right? About $8,200, $8,300 in bottom line liability. And I say, okay, well, let's send your property addresses, the 3 real estate addresses, over to our cost seg specialist. See if you are a candidate for cost segregation. I kind of had already assumed that he would be a candidate for a cost seg election, but I have to lean on my vendor, my other vendor for cost seg and all of the benefits, because I don't know what's going to be able to, or what we're able to accelerate until I see that preliminary analysis. So we send our cost seg election request over to Jeffrey Gann at GTG Consulting, and he sends back a preliminary analysis, which is basically allowing taxpayer A to accelerate $400,000 in bonus depreciation. Now, back in 2022 and 2021, bonus depreciation was at 100%. So any dollar amount that we're able to accelerate through this election is going to be a 100% write-off. However, taxpayer A is not a real estate professional yet. Taxpayer A is an LADWP W-2 employee. So there will be some limits to what he can accelerate, and any amounts that he's not able to take, we just kick forward into future years. So he doesn't lose it, he just doesn't use it. So we move forward with this cost seg election, 400 grand we're able to accelerate. And so he's able to take in 2021 roughly about a $44,000 deduction out of the $400,000. So what does that leave him? $356,000 in accelerated depreciation that he's not taking in 2021, but is able to carry forward into 2022. Well, even though he's only allowed about $44,000 of the accelerated depreciation, that kicks him from owing the IRS into getting an IRS refund of just shy of $6,000. And on the state side, now a state refund of $1,392. So we are helping the taxpayer make this election, accelerating the bonus depreciation, allowing even a non-real estate professional to take $44,000 upfront in 2021, carrying forward $354,000 into 2022, which then will help him offset cash flow in 2022. But what he did with this tax savings benefit, and then also other monies that he had saved up, is he took that tax savings, $12,000, $13,000, $14,000 delta in bottom line liability, and he added it to another down payment on a new property in 2022. Well, what do you think we did in 2022 with the new property acquisition? We did another cost seg election, and now carrying forward, kind of fast forward into 2025, we have roughly about $800,000 in carry forward cost segregation depreciation. Meaning that, and how does this work out in numbers, right? Let's say that taxpayer A is done buying real estate, and his cash flow is now, let's say, 50 grand a year. But he's got this massive kind of carry forward deduction amount, let's call it 800 grand. If we take 800,000 divided by $50,000 in cash flow, positive cash flow per year, that means that for the next 16 years, taxpayer A doesn't have to buy another property. And on the 50 grand each year for the next 16 years, if that's consistent, and it will go up because cost of rent goes up, cost of living goes up, all of the above. But for the next 16 years, he can make 50 grand of cash flow, positive cash flow profit, and not pay any income tax for 16 years. Because he has taken that 27.5 year depreciation amount and taken a chunk out of that and accelerated it to take it all in 1 year, which he didn't use it all, right? But he gets to carry that forward, and now every single year he doesn't have to worry for the next 16 years. He doesn't have to worry about paying tax on his real estate cash flow. Now, for those of you who are veteran investors, you're probably thinking to yourself, well, Tony, what happens if in 2025, let's say June 15th of 2025, taxpayer A decides that he doesn't want one of his properties anymore? What happens to all of that depreciation that he received a tax benefit for if he just outright sells the property? Well, if taxpayer A decides to sell one of his properties or his entire portfolio, any depreciation that we've taken as a tax benefit on those properties, whatever he's selling, whichever properties he's selling, we have to recapture that depreciation, add it back onto taxpayer A's return as ordinary income, and pay income tax on that benefit. So the government requires us to give back that tax benefit. There are only two ways under the current and future and past internal revenue codes where you can avoid depreciation recapture. Number one, which is the most common, is a tax-deferred 1031 exchange. That means that you're selling the property, but not selling it outright. You're just trading the property for another equal or greater investment. You could do a downleg exchange where you go from $1 million property into $500,000 of property, but then you have something called boot, where you're paying tax on whatever amount you're not deferring the tax on. Gets kind of complicated, right? That's why you have, tax professionals in the mix with all of this. That's number one, 1031 exchange. Number two, the only other way to basically avoid the recapture depreciation, unfortunately, is somebody's got to die, right? Because in death, let's say that I am taxpayer A, and let's say that I'm married. When I pass away, my wife will inherit all of these assets with what's called a stepped up basis benefit, meaning that as long as our real estate portfolio is under $25.2 million at the moment, that estate exemption is set to change. We don't have that final figure yet for 2025, but let's assume that it's the same as 2024 and we're married, so $12.6 million per taxpayer. So as long as the real estate portfolio is under $25.2 million and all of our other assets included are under $25.2 million, my wife receives that stepped up basis benefit, essentially getting to reset depreciation, so that my spouse, literally a week after I die, could liquidate all of our real estate tax-free, which is an incredible benefit. It's like this windfall kind of winning the lottery benefit, but I had to die in order for my wife to win the lottery, right? So a very dark topic, obviously, but most taxpayers don't understand how all of this works. That's why we are here to assist and kind of navigate the rough waters of past, future, and present Internal Revenue Code. So like I had mentioned, Section 1031 exchange is one of the major ways that you can avoid that depreciation recapture. Section 1031 has been on the chopping block many times as the IRS and the federal government have passed new tax codes, and it seems to withhold or stand the test of time. It is one of the oldest parts of the Internal Revenue Code, I think dating back to 1921, if I'm not mistaken. So it's over 100 years old, Section 1031. And I don't think that this will ever change, to be real honest with you. I knock on wood, and I'm hoping that I'm not wrong. But at the 23rd hour, at any given year when they're trying to change tax code and the government's trying to tax capital gain or capital assets on the real estate side, the federal government at the 23rd hour decides not to change Section 1031 because there's too many benefits around it. It makes up for something crazy like 65% of most U.S. real estate transactions. Maybe not on the commercial side. I forget what it applies to, but 1031 exchanges make up for a large chunk of all kind of residential and I think commercial real estate transactions in the U.S., which means that if you capped it or limited the benefit on 1031 exchanges, you would be crushing a billion, if not trillion-dollar industry. Which, if you think about it, how many people get paid when a property is acquired, sold, or exchanged? Because remember, in a 1031 exchange, a property is still being bought and sold, right? It's just there's an accommodator in the mix. In fact, when you have a 1031 exchange, 1031 exchanges specifically create more jobs than a traditional sale of a property does. And all of those revenue streams that are created, all of those jobs and those people being paid, they pay income tax to the federal government. So I truly believe that saner heads prevail at the 23rd hour where they think, why would we ever change this? It's not really impacting our ability to collect tax revenue. Sure, that individual is avoiding long-term capital gain tax and depreciation recapture tax, but eventually down the road, there will be some sort of tax that is generated. But in the meantime, we'll just take the benefit of all of the jobs that are being created and the revenue streams that are being created through an exchange and taxing those revenue streams. I think that that's the thought process of the federal government. Trying to think of how the government thinks of things and their rhymes behind their reason, or the reasons behind their rhymes, or whatever that saying is, it would drive us crazy to try and think that we knew what the government was thinking at any given time. But I do believe that that's what the end-all decision is, where saner heads prevail and they don't end up changing that. Last but not least, as we kind of wrap up and do some Q&A, I did want to mention that 4 red flags that you always want to be aware of when filing your individual returns is when you take excessive credits or excessive deductions compared to income, when your deductions exceed your actual income. Just always be aware that the government might want to tap you on that and say, hey, listen, well, how did you survive? If you spent all of your profit and you're showing a loss, how did you afford to pay for food and other things for a household of 2, 3, 4 individuals, right? Well, that could be an easy explanation. Maybe you got gifts from a family member that year. Maybe you borrowed money and had personal loans. Maybe you had savings. Maybe you tapped into a HELOC and equity in your home and you use that HELOC to pay for all of these expenses. There's a number of reasons why you have excessive credits or deductions compared to income. Missing or underreporting income, refundable credits, and rounding numbers. These are probably the major red flags that will ping the IRS and give them the opportunity to question things on the individual and business returns that you file. So one major job of an accountant and a tax preparer is to figure out how to navigate around some of these red flags. I mean, you're going to run into these scenarios anyway. There's no way to avoid refundable credits when refundable credits are due. There's no way to avoid excessive credits and deductions compared to income if that's truly the case. But what you can avoid is, or at least play a chess game with the IRS on, is telling the story of why that happened on your return for that specific year. One thing you definitely can avoid is not using round numbers. I can tell you that right now. If you give me a list of expenses where you're saying, oh, I spent $2,000 on airfare, I spent $5,000 on office, I spent $1,000 on gifts, I'm not going to use those numbers. I'm going to use $2,132, $5,046. I'm going to use exact numbers because round numbers give the IRS the opportunity to assume under audit that you are guessing. at these numbers, that you didn't actually go back and add up all of these numbers to come up with this figure. So you always want to use exact numbers. That right there alone will help reduce your audit rate significantly. Now, I know that people don't like talking about audits, but I do want to give you some good news that the audit rates on all of these returns are still incredibly low. Partnerships have less than a 0.1% chance for audit. S corporations have less than a 0.1% chance for audit. C corps have a little bit higher of a risk for audit, but those are like the large corporations of the world: eBay, Starbucks, Amazon, Google, Tesla, so on and so forth. But individual tax returns still, at the end of everything, have less than a 0.38% chance for audit, not 38%, but less than 0.38% chance for audit. And these are data pulls from the compliance presence website. So, on the IRS website. So just understand that these are not numbers that we're just making up. These are not audit rates here at Robert Hall & Associates. We do close to 12,000 tax returns, and our audit rates are way lower than this. We're talking about 0.001%, 0.0038% for our clients, because our EIN number for a 54-year-old company has incredible rapport and an incredibly great standing with the Internal Revenue Service. We're not just a new accounting firm that was set up just last year. We've been in business for 54 years. We know agents at the IRS, and they know us because we've been around for so long. And when we go and represent our clients and they realize, oh, it's Robert Hall & Associates, or it's Tony Watson, or Bob Hall, or Michael Watson, or Philip Duncan, or Daniel Passon, when they see our EIN number and our preparer ID numbers on the returns, they know that we've been doing this a long time. So just understand that the audit rates are still pretty darn low at the end of everything, at the end of the day. Most audited returns, get this. This is incredible. This is just absolutely incredible, and I'll explain in brief detail why. Most audited returns are incomes under $25,000 and incomes above $500,000. Now, I understand the $500,000 number, right? The government wants to make sure that at a higher income level, when you're writing off all of these expenses, it's saving them more than it's saving somebody who's making $50,000 a year, right? Because the tax rate at 500 grand or higher is a higher tax rate. It's 28 to 32%. So every dollar that a person making that kind of income is writing off, it's saving them 28 to 32 plus cents on the dollar on the federal side. It's saving them a lot more tax than if you're making 50 grand. So why are audited returns, or why is income under 25 grand a highly audited return? Well, when you are under 25 grand, you are more likely than not qualifying for government subsidy programs. Not only subsidy programs like not unemployment benefits, but specific disability benefits. Your kids are getting government funding for education. But on top of those other things outside of the actual tax filing, under 25K, you're probably qualifying for something called the EITC, Earned Income Tax Credit, which is literally the government opening up their piggy bank or their checkbook and cutting you a check just for being a low-income U.S. taxpayer. The government wants to tap you on that. They want to make sure that, hey, I see that you made $500,000 gross, but you wrote off $475,000 in expenses to get yourself below 25 grand or whatever, and now you're qualifying for these government subsidy benefits. Well, we want to make sure that that's legit. We want to make sure that you're not writing off personal expenses, that you are not making up some of these deductions, taking the reasonable allocation of in-home office expenses, so on and so forth. So just understand that if you're between 25K and 500K, you actually have the lowest audit risk out of any other tax return. And this is not gross income. This is not AGI. This is taxable income below 500 grand or taxable income above 25 grand, where you have one of the lowest audit rates. As far as QBI is concerned, I did want to mention this. This is still in play for 2025. I do believe that the thresholds will change once the tax bill comes into effect. But currently, if you're married filing joint, you're going to hop over to the blue column. If you're single or head of household, you're going to follow the red column on the right. As long as your taxable income married filing joint is under $364,200, and if you're single or head of household and your taxable income is under $182,100, the first 20% of your cash flow on your rental properties or self-employed business profit, the first 20% of whatever those numbers are, pays 0% in federal income tax. So how does that work? Married filing joint, let's say you're making 300 grand in cash flow or self-employed net profit, 300,000, let's say it's all self-employed income or cash flow. 20% of 300 grand is what? 60 grand. That means that $60,000 of the $300,000 pays nothing in federal income tax. Why am I bringing this up? Why is it so important? Is prior to the end of the year, aside from meeting with your accountant during tax season to actually file the return, you should be meeting with your accountant prior to year end. And I talked to Dimitri and I talked to a lot of our mutual clients before year end to map out a year end wind down strategy. Right? Well, if you're sitting at $380,000 in taxable income, you're starting to phase out from the QBI benefit. Well, let's go ahead and throw more into your solo 401k. Let's go ahead and match that plan through your business. Let's go ahead and go out and make that purchase of the new vehicle because you were already thinking about doing it, but you just didn't know if timing was right. Let's go ahead and make that purchase prior to year end to drop you below $364,200 in taxable income, now qualifying for that 20% of taxable income of your self-employed or cash flow income tax-free. It's all part of year-end planning. It's incredibly important for us to have eyes on this prior to year-end. So I think we're ready for Q&A, Dimitri. I just wanted to mention once again, we do offer free consultations, 30 minutes in person or over the phone. Obviously, June 5th today, we don't have a final tax bill, but I would suggest trying to get on the calendar as quickly as possible because I feel like this year is really going to start to ramp up in the next 2 to 3 weeks, and we want to get you on the calendar, get you service, get your questions answered, see if we're a good fit for you from a tax preparation standpoint. And that's all through, once again, a free consultation. So you can reach out to our office directly. Probably the most effective and efficient way to get on the calendar is just to shoot me an email at TonyWatson@RobertHallTaxes.com. I'll connect you with our new client intake department. We'll get you on the calendar and send over a copy of your most recently filed return. Let us review it prior to the appointment. That way we can have a strategy ready to go once we hop on the phone or meet in person. So,
Tony, excellent stuff as always. We do have several questions coming in here.
Sure.
First from V, are there any potential changes for real estate professionals? And that came in when you were covering the topic. So is there anything that is on the horizon?
Listen, I have been waiting for the phase out of the real estate professional real estate loss election because right now it's phasing out between 100 and 150,000 adjusted gross income. I have been waiting for an update on that in some fashion, and in my 20-year career, it's always been between 100 and 150,000. The real estate professional part of the code is one of the oldest parts of the code as well, dating back to 1962. At the moment, there's nothing solidified. There's talk of some changes based on adjusting phase outs and elections, hours of professional use. We're not hearing about a lot of this. We hear about it because we go and have these educational seminars with the accounting world, which a lot of taxpayers aren't privy to. But the details that you know about so far of the big, beautiful spending bill that could pass, a lot of that stuff hasn't been talked about yet. So is it possible for things to change? Yes. We have no verbiage on that whatsoever. But I have heard discussion of changing the phase-out threshold. I've heard discussion on the limiting of the hours to 500 hours versus 750 hours in the real estate professional world. I just don't know if any of that's possible. And to be real honest with you, if you're asking me personally, I really don't think any of that's going to change, unfortunately. But I hope it does. I hope it does.
All right, we have a next question from David. It's actually two questions in one. And I think first one for me, and then I'll let you handle the second one. So David is asking, how does the capital gain work if you purchase an investment property in your solo 401k? Well, solo 401k is a tax-deferred retirement vehicle. So when you purchase a property inside of your self-directed solo 401k plan, it's not you who are the buyer. Your 401k is the buyer. So it doesn't affect you personally when you buy the property or when you sell the property. And because 401k is tax-deferred retirement vehicle, it's not a taxable event. So you don't have to do 1031 exchange. It doesn't. You don't have to wait a certain period of time, or there is no limit for you to buy a replacement property. If you're doing it personally via 1031 tax-deferred exchange, you can buy a property, sell it, and then you can wait a year, or maybe even longer, and then sell the property, and there's going to be no tax consequences. Tax consequences only when you take a distribution from your 401k. And now the second part, are you able to convert personal residence into investment property And if so, how long does it need to be leased prior to buying a 1031 exchange investment property?
So I've seen people convert their primary residencies their rental properties into primary residencies and vice versa. There are some restrictions under a solo 401k, right? Because what was that arm's length transaction or a conflict of interest? I forget what the
Well,
ruling is.
no, Tony, this is not related to the 401k. So somebody owns a rental property. I'm sorry, somebody owns a residence. They
Yeah,
want to convert that to a rental,
yeah.
and then they want to do 1031 exchange on that rental property.
Yeah, I was just mentioning that it
Sure.
does make a difference whether or not the property is owned personally versus in a retirement plan. So, yes, I mean you can if you live in a primary residence and you want to essentially forego the Section 121 exclusion, because as soon as you move out of a primary residence, you start the clock on losing the 2 out of the past 5 year exclusion, which if you're married filing joint makes 500 grand of any capital gain tax free. If you're single, makes it 250 grand of the cap gain tax free. So as soon as you pass that threshold and you no longer can qualify for 2 out of the past 5 years on that property as your primary residence, you lose that benefit, right? So yes, you can move out of the primary residence, turn it into a rental property. And to be real honest with you, most exchange accommodators will tell you that it has to be rented out for at least a year and a day. I have seen exchanges done with accommodators where the property was rented out for less than a year and a day. It's really not something that is a highly audited point with the IRS. If you can get an accommodator to do an exchange on a property, even if it's been rented out for 6 months and we've reported it on a return, that solidifies it as a rental property from a compliance standpoint, I believe, with an accommodator. I've seen it all. But yes, is it possible? If you want to go by the book, it has to be rented out for a year and a day and established as a rental property on your return, literally set up for depreciation purposes, so on and so forth. And then when you 1031 exchange into that rental property, I believe that in order to avoid any recapture depreciation, if you decide to move into that rental property because of economic hardship, significant life changes, I believe that new property, I want to say it's 2 years and 1 day that it has to be rented out in order for you to change or alter that new investment that you're exchanging into. But I've seen it done in a number of ways in my career, and it does come down to the accommodator. The accommodator is really going to be the judge and jury on what the do's and don'ts are timeline wise for what qualifies for the exchange.
Gotcha. And it's probably, Tony, speaking of the timeline, it makes sense, or it will make more sense for somebody to perhaps buy the property in a Q3 or a Q4, and then maybe do it in the Q1 of the next year rather than doing it in the same year, so that there is a tax return, right?
Correct. That absolutely correct. So you don't want to do it. You don't want to buy and then 1031 exchange all in 1 year. You do want it separated out. So we have 1 year of established rental use and depreciation deductions on a tax return.
Okay, next question from Luis. Should I maximize my 401k contributions or direct these funds for real estate investments?
I mean, I'm not a wealth manager, so I can give you my personal opinion. I can't really even give you my professional opinion because I can't tell you to do one thing or the other. One, without knowing what your tax situation is. Two, I can't really tell you what to do with your money. I could tell you what I've seen. And I have clients who do both. I mean, obviously, if you're looking for the tax sheltering benefit right before year end, then you maximize your 401k contribution, right? That helps you dollar for dollar reduce federal and state income tax. And then within the solo 401k, you can diversify those investments and buy real estate investments through the 401k. As far as investing outside of the 401k, remember that if you buy a piece of a rental property and you have gains on that rental property outside of a 401k, it's all realized income, right? Whereas under a 401k, it's all deferring the tax unless it's a Roth account. But with a solo 401k, it's kicking the tax can down the road, and any gains on sales or any cash flow benefit, it's deferring the tax until you hit retirement age. So that's a little bit of a loaded question. I would need to see a little bit more individual income and tax detail in order to advise on that end. It's really not just a clear-cut answer, unfortunately. on that
Thanks,
subject.
Tony. Another one from Mark. Are there any updates on the 1031 timelines for transactions in 2025? I believe you
No,
covered that, but
nothing yet. Nothing yet. Still 45-day identification period, 180 days to actually cover the exchange. Could those change? Sure. I'll be real honest with you. I've read some of these updates, and I thought maybe by the end of tax season we'd have a final bill. At this point, it's all speculation. So many things could be kicked back to the House, amended, corrected. For me to give you any information about a tax bill that is not solidly in place or solidified or signed by the president, it's not fair to you, because then you go about your day thinking that certain things are going to happen. You might make financial decisions on your end based on what I tell you, and that's not where we're at right now. Like I said, this is the first time in my 20-year career I've had this problem on June 5th. I don't have any guidance yet. So could things change? Yes. But I do believe that there's going to be an uphill battle if the Senate doesn't agree with the House, and there's a lot of pushback right now from the Senate on certain things. And if Trump ends up having an issue with something, he could kick it back as well. So, we'll have to wait and see for the final bill, what actually lands in there.
thanks, Tony. Another question from Mohammed. I believe it refers to the audit stats that you showed earlier. Does the income 500K mean taxable income or 1099 income?
Are you talking about the audit, the most audited returns? Is that the question on this?
I believe so. When you were showing like 25,000 and then over 500.
Yeah, like I had mentioned, it's taxable income. It's not your gross income. So your gross income might be $1 million, right? But if you have $600,000 in expenses that adjust that $1 million gross down to $400,000 in taxable income, that's the number. You're still at $400,000. You're between the $25,000 and the $500,000 threshold. So it's not gross income, it's net income.
Yeah, so the 1099 doesn't necessarily represent your taxable income. It might be different,
Correct.
very different, in fact.
Correct.
All right, next question from Victoria.
Dimitri, I have time for one more question. I got a hard stop at 11. I have an appointment.
Okay, so let's take one last one from Victoria. What would you be the best email to reach? Well, I believe it is right there. Tony Watson at rabbithole.taxes.com. Thank you again, everyone, for joining us. We had a great hour filled up with valuable information. Go and implement that. And you guys have a great rest of the day, and we'll see you next time. Thanks, Tony.
Thank you, everyone. Take care.